$5,000 gold is no longer a wild prediction, it's a warning. December 2025, something unusual happened. JPMorgan's commodities desk, the same group that predicted the 2011 silver spike and the 2020 gold surge, quietly released a note to institutional clients, not to the public, not to retail investors, to insiders. And the message stunned everyone who actually understood what it meant. Gold enters a forced repricing event if the Federal Reserve performs its final rate cut. Forced. Not speculative, not gradual, forced. Now here's the part nobody's talking about. Every time the Federal Reserve hits its last rate cut, the moment when they move from fighting inflation to fighting collapse, gold doesn't rise slowly, it detonates. Every single cycle ends the same way. The currency weakens, liquidity floods the system, and gold revalues upward, violently and permanently. But this time is different. This time the structural math is irreversible. The U.S. government's interest bill surpassed $1.3 trillion. The Treasury has to refinance $9 trillion by 2026. Foreign demand for U.S. bonds is collapsing, and the Fed's balance sheet is trapped between a banking failure on one side and inflation that refuses to die on the other. So here's the paradox. No analyst on TV will admit the Fed's final rate cut is not a stimulus, it's a surrender. Because once they cut, truly cut, the bond market breaks, the dollar fractures. And gold, for the first time in modern history, becomes the lifeboat for both institutional money and sovereign wealth. Think about that for a moment. If every debt-based asset begins losing credibility at the same time, what else is left? Let me show you what JPMorgan sees that the public doesn't. Let me show you the historical pattern that has never failed. Let me show you why $5,000 gold is not a forecast. It's the mathematical consequence of a system that has run out of exits. To understand where this is going, you have to see the mechanism the Federal Reserve never explains publicly. Because gold doesn't rise when the Fed cuts rates. Gold rises when the Fed has no other choice but to cut. Here's the part nobody realizes. Every modern financial crisis begins with the same invisible signal, the moment when interest payments grow faster than the economy itself. Once that point is reached, the government can no longer fund its debt honestly. It has to print, borrow, or manipulate the system just to survive another fiscal year. According to Treasury data, the United States crossed that line in 2024. And by 2025, the interest bill grew so large, it exceeded defense spending, Medicare, and soon Social Security. This isn't a policy failure. This is mathematical failure. And history shows what happens next. In 1971, Nixon cut the final link between the dollar and gold because the U.S. could no longer afford foreign claims on its currency. In 1999, the ECB began its first major liquidity operations just months before gold bottomed and launched into a multi-year bull run. In 2008, rate cuts triggered a flight into hard assets as the banking system imploded. In 2020, emergency stimulus sent gold to new highs as the Federal Reserve performed the fastest balance sheet expansion in history. This already happened before. And every time, the pattern accelerates. Now, let's bring this into the modern era. The largest buyers of U.S. debt, China, Japan, and Middle Eastern sovereign wealth funds, are reducing Treasury purchases at the fastest pace in 20 years. Global central banks are accumulating gold at record levels, and U.S. banks are quietly preparing for liquidity stress tests that assume a major credit event within 12 to 24 months. Think about that for a moment. Foreign governments are stepping away. Domestic banks are hedging against collapse, and the only buyer large enough to keep the Treasury afloat is the Federal Reserve itself. Which leads us to the trap. If the Fed raises rates, the Treasury risks insolvency. If the Fed cuts rates, inflation reignites instantly. Either direction ends with the same result, a loss of confidence in the dollar. And when confidence breaks, money searches for the one thing that has no counterparty risk, no printing press, and no political vulnerability: gold. This isn't speculation. This is the same structural dynamic that broke Britain in 1931, the Soviet Union in 1989, and dozens of developing economies whose currencies collapsed when debt exceeded growth. And now, for the first time, the world's reserve currency is entering the same phase. Here's where the math becomes undeniable. If the Fed performs its final rate cut, the cut that signals they've abandoned the inflation fight, the dollar weakens, bond yields collapse, and liquidity floods the system. At that moment, a global repricing begins. Not controlled, not gradual, violent. JPMorgan estimates that even a modest shift in institutional allocation, just 1% of global bond portfolios moving into gold, would push prices to $5,000. But that's the conservative estimate. Because when a currency loses credibility, the flow is not 1%, it's everything. Here's the truth institutions whisper privately, but will never say on camera. The next gold surge won't be a commodity rally. It will be a confidence event. And when confidence evaporates, the revaluation is instant. Let me show you how close we are to the trigger. The trigger is hiding in plain sight. It's the moment the Federal Reserve signals the final rate cut. The cut that tells the world they can no longer hold the line. The cut that says the inflation fight is over, not because they won, but because they ran out of ammunition. Here's the part nobody realized. When the Fed cuts for the last time, it's not a victory lap. It's an admission of defeat, and the bond market understands this instantly. Treasury yields collapse, the dollar weakens, and global capital exits. Paper assets like a fire alarm just went off. Institutions rotate first, family offices follow, retail investors come last, but by then, the repricing is already underway. This isn't about rate cuts. It's about what rate cuts mean when debt is unsustainable. Let's walk through the mechanism. The U.S. now spends more on interest than on Medicaid, veterans programs, and national defense. By 2026, interest could surpass Social Security itself. That's not a forecast. That's the Treasury's own math. So when the Fed cuts rates, they aren't stimulating growth. They're preventing default. And every investor who understands this shifts into the only asset that rises when trust in the currency collapses: gold. This already happened before. It happened in the late stages of the Roman Empire when debased currency forced citizens into silver and grain. It happened in Weimar, Germany, where gold preserved purchasing power while the mark evaporated. It happened in 1979 when the last wave of stagflation sent gold soaring more than 2,000%. It's happening again. And the timeline is not abstract. It's already visible. Corporate debt maturities peak in 2025-2026. Federal interest costs breach historic levels. Foreign buyers reduce Treasury demand. The dollar weakens against every major reserve asset. And the Federal Reserve is cornered with only one move remaining. When they make that move, gold is revalued overnight. Not because of scarcity, not because of industrial demand, but because the global financial system needs a new anchor when the old one breaks. Think about that. The world doesn't run on dollars. It runs on trust in the dollar. And trust is the one resource the Federal Reserve can't print. Here's the real shock. A $5,000 gold price isn't a prediction. It's an equilibrium level once the system resets. At that price, the gold held by central banks is sufficient to partially backstop their currencies. At that price, global debt-to-reserve ratios stabilize. At that price, confidence returns. Not because governments restored it, but because the math forced it. This is why JPMorgan issued their warning. This is why central banks are buying the fastest in recorded history. This is why the largest institutions in the world are preparing for a world beyond the final rate cut. Now let's talk about you. When this shift begins, it moves too fast for late adjustments. Portfolios built on bonds melt first. Portfolios built on equities follow when earnings collapse. Cash loses purchasing power silently, then violently. But tangible assets, gold, silver, real stores of value, do the opposite. They reprice, not gradually, but explosively, as the system seeks a new foundation. You don't need to predict the exact week or the exact meeting. You only need to recognize the pattern that already took shape in 1929, 1979, 2008, and 2020, and is now repeating. The Fed's final cut is coming. The world is already adjusting, and when it happens, the revaluation will not wait for anyone. You've seen the pattern, you've seen the math, and now you understand why $5,000 gold isn't the ceiling, it's the beginning. Now let that echo for a moment. There is one final piece of this puzzle, the part every major institution sees, but the public refuses to imagine, the part that turns a gold surge into a global reset. When the Federal Reserve makes its last rate cut, the U.S. government faces an impossible math problem. Lower rates reduce interest costs temporarily, but they also collapse the dollar's yield advantage. And when yield disappears, foreign demand disappears with it. Think about that for a moment. Foreign buyers already reduced Treasury purchases by billions. China is divesting. Japan is defending its own currency. Oil nations are shifting to metals. This is the first time in modern history that the world is rotating away from U.S. debt before a crisis, not after. Here's the part nobody realized. If foreign demand continues to fall while U.S. debt continues to rise, the government will be forced into the oldest play in the book: monetary devaluation. Not an announcement, not a public statement, a repricing of the currency through the only asset that cannot be manipulated by decree: gold. This already happened before. In 1933, when FDR revalued gold from $20 to $35 overnight. In 1971, when Nixon killed convertibility and the price exploded 2,000%. Every time the U.S. faced a debt wall, gold became the release valve. That mechanism never went away. It's resurfacing. Now, follow the sequence. The Fed cuts. Bond yields fall. Foreign demand collapses further. Treasury auctions weaken. Emergency liquidity facilities reappear. the dollar loses ground, and gold suddenly becomes the only safe collateral in a system running out of trust. This is where the $5,000 forecast stops being a forecast. It becomes the clearing price, the level required to rebalance global confidence. Because once the US quietly accepts higher gold valuations, every central bank holding metal sees its reserves strengthen instantly, currency backstops improve, debt ratios stabilize, and the system breathes. But here's the darker side. Everyone without tangible assets gets wiped. Bank deposits lose real value. Bond portfolios disintegrate. Equities enter a volatility cycle that lasts years. The middle class experiences the silent tax of devaluation, a tax no one voted for, a tax no one controls. Meanwhile, those holding gold witness the opposite. Their purchasing power increases as the dollar resets. Their savings survive the transition. Their wealth becomes mobile in a world where paper promises are being rewritten. This is why central banks aren't waiting. This is why JPMorgan issued their warning. This is why the IMF quietly revised reserve models. And this is why the next phase won't be gradual. It will be sudden, it will be violent, and it will be irreversible. The last rate cut won't be the end of the story. It will be the beginning of a new monetary era. Some people will enter it blind, some will enter it prepared, but no one will enter it unchanged, because when the Fed makes its final move, the real reset begins, and gold becomes the only truth left standing.